If you've ever tried investing or started to invest, you've probably asked this question: dividends or growth? And depending on who you ask, you'll get two completely different answers and probably two completely different Reddit arguments. So today we're settling it with actual ETFs, actual stocks, no hype, no opinion, just numbers. Hey, if you're new here, I've spent a lot of time on this, and not just the theory, but actually trying to apply it to my real portfolio and figuring out what makes sense for where I am right now. And what I found might actually surprise you, because the debate is real, but the framing of the debate is completely wrong. Before we get into it, I just wanted to take a second. We just hit 10 subscribers. And I know, on paper, that sounds small, but each one of you chose to come back. You didn't have to. You clicked subscribe on a channel that has no followers, no track record, no viral moment. Just nonsense. Like literally just talking about finance and other stuff on the internet. That genuinely means more to me than I can explain or ever express. So I just want to say thank you, seriously. Now, let's get into it. Most people approach this like a sports rivalry, team dividends or team growth. They pick a side, they defend it on the internet, and they never actually spend any time investing because they've spent their entire time arguing. Okay, I'm kidding. But in all seriousness, it's like arguing over whether breakfast or dinner is the better meal. Like, you probably need both, man. You're gonna be hungry. Let's start with growth. Growth investing means buying into companies that are expected to increase in value over time. Businesses that are expanding, innovating, and reinvesting back into themselves instead of them paying out to you. A wonderful example of this is QQQ, the Invesco ETF that tracks the NASDAQ 100. It holds companies like Apple, Microsoft, Nvidia, Amazon. These are businesses that for the most part of their history have paid little to no dividend in their entire history. Instead, they've reinvested everything back into growing their business. The result? Over the past 10 years, QQQ has returned an annualized return of approximately 20%. 20% annualized for a decade. That's the power of growth compounding. Now, dividends are different. Instead of waiting for the stock price to climb, you get paid while you hold it. Companies distribute a portion of their earnings to their shareholders based on time metrics, whether it be weekly, monthly, quarterly, or even yearly. And it's all based off of the ETF and stock and how they determine that. The classic tried and true example is SCHD, the Schwab US Dividend Equity ETF. It holds about 100 high-quality dividend-paying companies like Johnson & Johnson, Coca-Cola, Verizon. And they're selected based off of metrics, selected on dividend yield, their 5-year dividend growth, and just their financial strength. SCHD currently yields roughly 3.44%, which means that if you put $100,000 into SCHD, you would yield in a year roughly $3,440 without selling a single share. And for a lot of people, that feels real. It's that dopamine hit. You see money hitting your account. It feels like progress even when the market is flat. Here's what the data actually shows us. And I want to be completely honest here, because the numbers tell a nuanced story. Over the long run, dividend-paying companies have a surprisingly strong track record. Over the past 5 decades, S&P 500 companies that grew or initiated dividends achieved an annualized total return of 10.2%, compared to just 4.3% for companies that paid no dividends at all. That's not a small gap. That's more than double. From 1973 to 2023, dividend-paying stocks delivered an average annualized return of 9.17%. which was significantly higher than the 4.27% achieved by non-payers. And they were 6% less volatile than the S&P 500. So on a 50-year horizon, dividend payers actually won, and with less turbulence. But, and the biggest but of the buts, that actually changes when you zoom in.
That's what she said.
Over the past decade or so, dividend stocks have underperformed the broad US equity markets. And the reason is pretty obvious when you actually look at what drove the market the past 10 years. Nvidia, Amazon, Meta, and Alphabet, none of which paid meaningful dividends for most of that period of time. So the honest answer is it depends on the decade you're measuring. Let me make this concrete with 3 ETFs that you've probably heard of. QQQ, Pure Growth, NASDAQ 100, a 10-year annualized return of approximately 20%, a dividend yield of 0.44%, a maximum drawdown from peak of 82.97%. That last number, let's just round up to 83%. That means at its worst, during the dot-com crash fire fiasco, QQQ lost most of its value. So yes, the upside is incredible, but you better have a stomach made of concrete for when things go bad. Next is YouTube's favorite love child, SCHD, a dividend quality ETF, a 10-year annualized return of approximately 12.28%, a dividend yield of 3.44%, a maximum drawdown of approximately 33.37%. Still strong returns, but with less than half the downside of QQQ. Now let's throw a third ETF into the mix, VYM. This is Vanguard's high dividend yield ETF. It has a 10-year annualized return of approximately 11 to 12%. It's more diversified with over 400 holdings compared to SCHD's, but with a lower yield than SCHD's of approximately 2.4%. Here's the takeaway that I hope that you get from this is SCHD and QQQ have a correlation of only 0.27, meaning their price movements are largely independent of each other. They zig and zag differently, which makes them genuinely effective as partners in a portfolio. That's not an accident, that's a strategy. Here's one of my favorite real-world comparisons of how this plays out with stocks. Imagine it's 2008 and you have to choose between Verizon or Visa. Verizon had the higher dividend yield and looked better on paper. Visa had a lower yield but was growing its dividend aggressively. Over a 16-year period ending in 2023, Visa's dividend grew at 21% annually compared to Verizon's 3%. And that higher growth more than compensated for the lower starting yield. Visa dramatically outperformed over the full period. The lesson, a high dividend yield today does not guarantee a high income tomorrow. What matters is whether the dividend is growing and whether the business can actually sustain it. Speaking of sustainability, Dow Incorporated is a cautionary tale. It offers roughly a 7.8% dividend yield, but in 2023 and 2024, its earnings per share of 82 cents and $1.57 were far below the $2.80 per share being paid out as its dividends. That's literally a 7.8% yield that the company can't afford to pay. That's not actual income. It's a timer counting down to a dividend cut. High yield isn't always a feature. Sometimes it's a warning sign. Here's the frame of mind that actually clarified all of this for me. Growth is for building wealth. Dividends are for using wealth. Look, if you're early, you're in building mode. Growth makes sense. You don't need the income. You need compounding and time. If you're later in the journey, dividends become more valuable because the question isn't how do I grow this? It's how do I live off this without selling everything? That's why financial advisors typically shift client allocations towards more income generating assets as they approach retirement. It's not a coincidence. It's an actual strategy. Personally, I run both. I lean towards growth because I'm still building, but I also hold dividend-paying ETFs for stability, and because seeing income hit my account is a dopamine hit. Also, I want to be completely honest. I am not smart enough to perfectly predict what strategy is going to outperform the market over the next decade. Nobody is. In 2010, nobody predicted that a graphics card company would become one of the most valuable companies in human history. And in 2000, nobody predicted that the obvious growth plays would crater 80%. So I'd rather not bet on everything being right. Because even when I think I'm right, the market has a funny way of showing me that I am just completely wrong. The biggest mistake that people make in this debate is they switch sides. They start with growth. They're feeling good, they're actually growing, and then growth starts to not happen. It starts to plummet. So then they switch to dividends, and they start generating income, and then the income starts to fall off, and then they're switching back to growth. They're always at the party, but they're already past the peak of the party. Dividend growth strategies like the S&P 500 dividend aristocrats, which are companies that have consecutively over the past 25 years produced dividends, have historically performed across a variety of interest rate environments. The consistency comes from staying in and not trying to time it. If you want to walk away with a clean mental model of what I'm trying to say, is that ETFs like QQQ or VUG are for growth. Maximum compounding potential, higher volatility, low or no income. And then ETFs like SCHD and VYM are for dividends. Steady income, lower volatility, solid but not explosive growth. If you combine both together, it equals a portfolio that can both grow and pay you over time. The goal isn't to pick the right side. It's for building something you can actually stick with through the good years and through the brutal years and through the really confusing years where for the next 6 months you're dressing like Blue's Clues and questioning why you ate that breakfast chimichanga down the road and now you're regretting it. Yeah, it's bad. In future videos, I'll break down my portfolio of both the growth and the dividends that I have of ETFs and the percentages I have allocated. If you're interested in videos like that, please click subscribe, that little button, and click the like button if you like this video. And thank you again so much for your participation, and I look forward to growing with you guys. Stay consistent out there, folks.